Hello and welcome to another episode of the Express Economist. As many of you know, in the last few months, especially in the last few weeks, the issue of rupee exchange rate and forex reserves has dominated the national discourse. There's a lot of worry about rupee falling against the dollar, and the RBI sort of spending a lot of forex reserves just to hold back rupee, and still it breached the 80 to a dollar mark. And for reasons which are not necessarily economic, the rupee's exchange rate has sort of gained a political significance. It's seen as a marker of weakness in the Indian economy, whereas the fact is that rupee is also strengthened against a lot of other currencies. However, the whole matter has repercussions for India's growth in the coming year and the coming decade. To understand more about these issues, we have with us a special guest. I would like to welcome Mr. Samiran Chakraborty, who is the Managing Director and Chief Economist, India for the CitiGroup. Hi, Samiran. And I would like to tell our viewers that I call him Samiran because he was my tutor at the Delhi School of Economics. So it's a very happy occasion for me to be able to host him in the show. And so let's kickstart the discussion by asking something that I think a lot of people who do not necessarily have a grounding in economics or are lay readers might be asking. Why do we fuss over the rupee's exchange rate or the forex reserves, the level of forex reserves? Why can't we let the rupee fall? If it has to fall, it's just an exchange rate. Samiran.
Thanks, Udit, for having me. And I've left my professorial hat a long time back in Delhi School, and now do some mundane stuff in the markets. So from that perspective, let me first kind of rephrase your question in some way and say that the problem for a country like India has been that we have never quite figured out that whether a depreciating currency is good for us or an appreciating currency is good for us. And that's because we are finally a net importer country. So while we all understand that some exchange rate depreciation might affect exports positively, we are always worried that it might affect our imports more negatively. So on the balance, what actually is the net effect of the two is unclear in policy circles, at least not been very well articulated. And to connect it with is this whole problem that what do we actually export? If you really get into the nitty-gritties of this, you will find that almost 40% of our exports are nothing but what you can call re-exports. We import something, we sort of process, add some value here and export it. So for 40% of exports, exchange rate is simply a pass-through. There's no net effect of that. And I can't give you an exact number, but a large part of our exports are also items on which we are price takers. We are not such large producers that we can set the world price. And in those cases, often what might happen is that when the exchange rate depreciates, the buyer of the product might say that, look, anyway, you guys are making money from exchange rate depreciation, please reduce the price. And there also the positive effect of exchange rate depreciation might not play out that well. Whereas I do understand on the import side, the exchange rate increases the cost of imports. So to that extent, imports might come down because of exchange rate depreciation. But still, it is not absolutely clear that by depreciating the exchange rate, you will necessarily be able to solve your current account deficit problem in the short term. On top of it, there is an issue that what is causing the current account deficit in the first place? Is it because volume of imports have gone up, or is it because price of imports have gone up? If the answer to the question is that the price of imports have gone up and not so much the volume of imports, which we do believe, then exchange rate anyway does not solve that problem. So you might let the exchange rate depreciate, but your current account deficit will remain where it is. And lastly, I would say that while this is all the current account type of discussion, there is a capital account discussion as well. And that capital account discussion is that when the currency starts depreciating a lot, then there is a natural bias for investors to think that it's not a good time to put money into India because they're ultimately bringing in dollars. And if the value of dollar against rupee is falling, then in that sense, they're losing money. In other words, if you're putting money into equities and equities are giving you 10% return, but the currency is depreciating 5%, then net you are only getting a 5% return. So from that perspective, also depreciation does not help. And let me end by saying that often this can lead to a situation where depreciation negates further depreciation. Why? Because the natural behavior of how exporters and importers change during periods of depreciation is significant. Think of it that if the exchange rate is depreciated, all exporters will think that this is not a great time to sell my dollars. I will get a better rate 2 days down the line, 7 days down the line, 1 month down the line. So he will hold on to all his dollars. Whereas if you look at importers, they will feel that, oh gosh, this is the time for me to buy all my dollars because tomorrow it will be even more expensive. So in the system, there will be a lot of demand for dollars in a depreciation period in excess of what is normal, whereas the supply will be dwindling. So in some sense, it will create more pressures of depreciation, which is why it is important to do this in a very calibrated fashion. And what you were mentioning is quite correct, that it should not just be looked at in the context of dollar. It has to be looked at against a basket of currencies. And I think RBI has taken an approach of keeping it somewhat stable against that basket.
So thanks for that lovely explanation about the various factors and a very crucial thing about looking at depreciation not in a very simplistic manner. The other side of the rupee exchange rate is the Forex reserves, as it were. And again, we fuss over Forex reserves also in a very similar manner, often with a jingoistic turn to it about being at a particular level. Now, for Forex also, I remember we were, long back in classrooms when we read, it was always referred to as precious foreign exchange. That term was always used, precious foreign exchange. So if you could just explain a bit also about the Forex levels. And in particular, I want to know that if we look at the balance of payment data, say for the last couple of years, more money was coming into India. More, in dollar terms, more dollars were coming in simple terms. Then we were storing more and more Forex reserves with ourselves, but we could have alternatively let the rupee appreciate at that time, isn't it? So why didn't we do that? So those two.
So, the first part of our discussion was about the question of willingness to let the exchange rate depreciate or not. The second part of your question is now about the ability of the RBI to do so. And that ability comes from the use of the Forex reserves. If they feel that rupee should not depreciate too much, then they intervene through their FX reserves and try to put a floor on rupee depreciation. Now, what limits this ability is how much reserves RBI should be holding at least. And there are different measures of reserve adequacy. RBI follows quite a few of them and regularly publishes data on them. Let me take up one of those reserve adequacy measures, which is easy to understand, which is called the months of import cover. And according to our estimates, the months of import cover is now about 9.5 months. Or in other words, if we do not have any other dollars, we can still import 9.5 months with the FX reserves that we have got. Now, there is no good number on what is the optimal months of import cover, but normally it is assumed that about 10 months plus of import cover is great. So we have just fallen a tad below that. But if you go back to the 2013 mini crisis period, we had months of import cover even lower. If we go back to 1991, it was much, much lower. So we are not yet in a crisis zone when it comes to the level of FX reserves that we hold today. Now, but at the same time, the degrees of freedom that we have in stemming depreciation by using these FX reserves, that degrees of freedom has come down. Obviously, at $640 billion 6 months back versus 580 billion today, there's a gap. But what we also, and this is slightly technical, is that the RBI also holds about $50 billion in the form of forward reserve. This does not get talked about enough. So truly their FX reserve is not 580 billion, but more like 630 billion today. And to that extent, they're actually above that 10-month cover. Now, your other question is very interesting about why can't RBI let the rupee appreciate or depreciate even times when BOP is in surplus? So the first thing to keep in mind, and this is very important to me, is that India is a structurally current account deficit economy, but a structurally balance of payment surplus economy. Because we always get more capital inflows than our current account. In fact, what happens is that every 5-7 years, we get 1 year of BOP deficit. In 2008-9, we had one. In 2013, we had one. In 2018-19, we had one. In 2022, we are having one. So typically, the process is that whatever reserves we lose during that BOP deficit year, we generally recoup much more than that in the BOP surplus years. Now, one thing that people don't understand completely is that if there is a BOP surplus, there are additional dollars in the economy. You and I, we are not going to hold any dollar bill in our pockets. So if in a surplus economy, the dollars will have to finally flow back to RBI. So if you look at historic data, it has always been the case that our BOP surplus, adjusting for some small things, is always equal to the reserve accretion of RBI. It has to, it's just by definition.
Yeah.
So it's not that RBI has a big choice out here that it will not intervene and buy these dollars. So the only question for a central bank is at what rate? Would they buy these dollars or sell these dollars at a particular level and kind of create a line on the sand saying that this is what is where the market rate should be? Or would they do it in a more distributed fashion? That's a tactical call that central banks will take. But I don't think they have a choice much when there is a BOP surplus. Their reserves will increase. The last point I will end with is that we are somewhat different from China in this context. We are different because our entire FX reserves is built on capital account surpluses, not on current account surpluses. In other words, this is actually the liability that we are holding, not an asset in some sense. So to that extent, the central bank will have to be much more cautious in using these FX reserves than in a country which runs a large trade surplus or current account surplus, where they can call their FX reserves truly as an asset.
Yeah, so, valid point, you sort of preempted my next question, which was on China, about China having a lot of Forex reserves and how does it manage and do that. And it's a very salient point for our viewers to understand the quality of Forex reserves. Either you can earn that by exporting more, or you could get a lot of money invested in your country because it's higher interest rates or growth prospects are there, but that is not the money they can always hold on to. It can just flow out very quickly as it has done. And so there's a quality issue with how you, what kind of Forex, what creates Forex for you. Okay. Now, having understood that, we have, as I mentioned, we have a Fed meeting coming up soon, and it is expected that because the inflation print in US is pretty high, it's over 9%, and the Fed has very aggressively said that they want to bring it down to 2%. Whether it comes down to 2% or not and how soon, that's a different matter, but the Fed is very resolute. There's a very good chance that they will increase the Fed funds rate, which is sort of the repo rate comparative there, by 75 basis points, or some people even expect it could go up to 100 basis points. Now, in one of the charts that you had also talked about, the gap between interest rates in India and interest rates in US is narrowing. And with that narrowing, the incentive to come to India for higher returns is also reducing. Now, if we imagine that the Fed funds rate will go up by another 75 basis points, how does that impact RBI's response, which again will be on August 5th? I think the date has changed by 1 day. And so if you could just reflect a bit on monetary policy response to this now, because we are just entering into this phase.
Sure, Udit. So let me break this up into theory and practice. What you just said is absolutely right in theory, that a country which has a higher interest rate, money should flow into that country vis-a-vis the other one. But let's get into the nuance first in the theory sense. The nuance is that the inflation also matters. In our working lifetime, this is probably the first time Indian inflation is going to be lower than US inflation. So once you adjust for that, the gap is not narrowing as much. The second issue is that there is also a currency element, that how much currency appreciation or depreciation you are building in. So if you believe that over a longer period, rupee is not going to depreciate too much, then probably in some sense you are still okay, even if there is an interest rate gap is narrowing. But let's look at the practical part. The practical part is that India is quite unique compared to some of the other Asian countries. Unique because we get more of equity inflows, foreign inflows, than debt inflows. So this interest rate sensitivity analysis works more for debt inflows, right? Because this interest rate is on debt products. Now, only about 1.5% of our outstanding bonds are owned by foreigners. Whereas if you look at equity, almost 17-18% of our equity market is owned by foreigners. If you go back to a Malaysia, Indonesia kind of countries, there more than 30% of their outstanding debt is held by foreigners. That's why they're more sensitive to this interest rate differential, because if the interest rate differential narrows, then there could be massive outflows from debt markets. Whereas in a perverse way, India, because it has more equity investments, if interest rates are relatively lower here, one would expect growth will be relatively better. And if growth is relatively better, then equity returns are relatively better. So actually money can flow in rather than flowing out. Ceteris paribus. So that way, this interest rate differential argument for India does not hold in so much. Now comes the absolute market nuance. The absolute market nuance is that there is also an element of speculation. And that element of speculation is that global currency speculators, they might feel that if India is too far behind the curve, not raising rates enough, then they might feel that at some point of time, the currency has to depreciate. based on that. So India might get singled out by these currency speculators, if I may use the word, and there can be more pressure on the currency coming from these speculative activities. So to that extent, we cannot completely stay misaligned from the Fed, but we don't have to go lockstep and barrel with every Fed move. So keeping all this in mind, our sense is that about a 35 basis point rate hike from RBI in the August policy is probably going to be good enough. We don't have to go to 50, but let's say hypothetically, if Fed does 100 basis point next week, then the chances of a 50 basis point hike by RBI would increase because it will not want it to completely misalign from global interest rate cycle.
On this very specific bit about India's inflation, I mean, there's one view that inflation has peaked. It's a similar thing that is being talked about in US also, where a lot of people are saying that inflation has peaked there. But what's your sense about inflation in India? It seems like most people do agree that even if it is peaked, that it will stay high or outside the RBI's comfort zone of 2 to 6%. What's your sense there?
So, I mean, you're right that even in our official forecast, we have inflation sort of in this quarter peaking out and then tapering off from there. But this is a very uncertain world. And that's why it's difficult to thumb the table and say that this is how this is going to play out. In fact, probably this is a time to be very cautious on all forecasts and all policy making. And let me highlight where the main challenge is. There are three main challenges in this inflation forecast. One challenge is that we simply don't know how global commodity prices are going to move. On one hand, there is a recession probability increasing, which should bring global commodity prices lower. Whereas on the other hand, the supply side disturbances, whether it is a war or supply chain dislocation, anything can keep commodity prices high. So that's one very uncertain element. The second uncertainty is about whether the current price pressures already happened, whether they have completely been passed through to the consumers or not. In other words, there could be some pent-up inflation in the system, which is going to show up over the next few months or quarters. Let's say, for example, coal prices have gone up, whether electricity tariffs would now go up as a reaction to that, and whether that will lead to another round of price increases in every product because everyone uses power. So those kind of things are a big uncertainty. And in some sense, I guess the main trouble that we face is to analyze whether we are going to see a wage price spiral or not. See, if it is a one-time price increase, then with a 12-month lag, this will be into the inflation rate and inflation rates will fall. But if it's a wage price spiral, then this can persist for longer. Now, we are seeing a very odd situation where urban wage growth has been relatively okay, formal sector. But if you look at the rural wage growth, the real rural wage growth is negative. So in some sense, there is a partial wage price spiral, not a full as yet. In fact, some would argue that till the rural wages increase, there's no chance of a wage price spiral happening in India. So this will be the third reason why forecasting the inflation persistence is going to be difficult. I can tell with some confidence that we are coming to the peak, but whether we will fall rapidly or not will depend upon how these three things are going to play out.
Right. Very, very valid points. Now, one of the, in policy circles and newspaper headlines, we've seen this, that the government has justifiably said that the whole issue about rupee losing value vis-a-vis the dollar is essentially an imported issue. We had war in Ukraine. The Fed is fighting its own battles, and we are getting impacted by all of that. But I want to ask you about the domestic side of it. And we've already discussed what the RBI can do or might do. But what about the government? I want to understand what is the fiscal policy, intervention in all of this. Where has fiscal policy played its role vis-a-vis Rupee? Can you just elaborate a bit on that?
So there are a few strands to this discussion. So the first strand is about the fact that today, fiscal policy is in some sense trying to absorb a bit of an inflation pressure. If you did not have a fiscal support, by now inflation would have been much higher. Let's say, for example, we are suppressing the fertilizer price pass-through by giving subsidy. We are cutting down on our excise rate on oil prices to keep retail petrol product prices lower. So to that extent, if inflation is lower, normally we would think that that should be appreciating the currency. Because if inflation is lower, exporters can work with a somewhat appreciating currency. So to that extent, fiscal policy is good in controlling the rupee depreciation. But the problem is that on the other hand, we need an expansionary fiscal policy. We are still running our general government deficit at maybe more than 9% of GDP. In that scenario, that excess demand that is getting created in the economy would also show up in our import numbers, would also show up in our current account numbers. That's why we call it a twin deficit problem, that when fiscal deficit worsens, generally it also makes the current account deficit worsen. So to that extent, the external sector pressure that we are seeing on the currency from higher current account, we are expecting more than 3% of GDP current account deficit. That is coming because of, to some extent, the fiscal stimulus. So it's hard to say that on balance, which one would be the dominating factor on the currency. But over the medium term, we need to get our fiscal balances, fiscal deficit lower if we want to have a more sustained low current account deficit and a more stable currency.
So, let me ask another question, which is sort of related, and ask the growth questions later. But, one thing that a lot of our viewers would have seen, that across the board, and it's fairly natural, executive state heads of governments have always said that, we've managed COVID very well. We've managed the economic fallout of COVID very well across the board, or whichever country you look at. But one clear distinction a clear distinction in a manner of speaking, was there in 2020 or 2021, was that it was said that Indian government is not spending as much during the pandemic, whereas a US or a UK was spending more, or any European country was spending more, giving actual money in the hands of people. Now the boot is on the other foot. Many people in India now are saying, look, we didn't spend much, and we have, as you said, lower inflation today than what it is in US. And for US, 9% is a massively high number. It's not like comparable with India at 9. So the argument is that India did really well by not spending as much. The counter argument is that, well, you didn't spend much. Your demand hasn't really come back in a big manner, unlike US, and you're still dealing with 8% of inflation. So you got the worst of both the worlds. So can you sort of reflect a bit on whether India's fiscal response, and now, as you said, going forward, we have to tighten our belts and manage our finances better. Did we overspend, not spend? How did it sort of pan out?
So, unfortunately, economic textbooks or models never would quite tell you what is an optimal level of fiscal deficit. It often becomes a political call, that what is the extent of fiscal deficit which is tolerable, so to say. Now, And this is important to understand because in hindsight, we tend to think that what we did around that global financial crisis time was excessive fiscal stimulus. Or at least we took a long while to remove that fiscal stimulus, which willy-nilly led to the 2013-14 mini crisis, taper tantrum. Now, that perception leads governments to think that we are not going to repeat that mistake again. So that automatically puts a political constraint on the extent of fiscal deficit which is tolerable, if not anything else. There is always another rating agency angle there, which because we are now on the lowest rung of investment grade rating, maybe there is that perception that if our fiscal worsens a bit more, if we go into non-investment grade, then it could have many more ramifications through the economy. But even if I keep that aside, I think that baggage of 2008-9 is very much there, which constrains us on how much fiscal deficit we can expand. But on top of it, there is also some natural issues. Look at our expenditure pattern. Almost 75-80% of our expenditure is prefixed. We just can't change them. It's interest payment, it's salaries, defense expenditures, subsidies, grants to states. These are not numbers you can change. So our ability to put additional stimulus is also limited by the nature of our expenditure. And it's also limited because some of the schemes that other countries have done to very quickly put money in the hands of the people are just too difficult for us to implement in such a heterogeneous economy with not enough correct data, not enough distribution methods. So those things can also limit our ability to stimulate demand quickly. Now, in hindsight, I think what the government did was quite right. Today, we are not being clubbed in a very difficult zone along with other countries because we have done pretty decent fiscal management, in my view. Why are we getting still 7% inflation? Well, it's global commodity prices. I don't think we are having that much of a domestic demand-led inflation. It is more of a global inflation fallout that we are also being impacted. So I will not actually blame expansionary fiscal policy for our current inflation issue. But as I said, that we need to keep a constraint on fiscal because of managing the current account and managing what we economists call the crowding out issue, that the government is borrowing so much from the markets that there is not enough money to be given to others. And in that sort of situation, interest rates can go up to do that rationing. And that is obviously something we want to avoid.
Right. It's a valid point. But I just want to get to the next issue about growth by linking another aspect of that of this issue. That when we often talk like this, we've been talking, say, half an hour and about variables, and often it appears as if the economy is only about variables and deficit, this percent, that. But the real life, when we go out and look at the state of Indians, inequality, poverty, their household incomes, that demand, many of those things don't always accurately get measured in the numbers. The stress that might be there might just get never captured in these neat numbers. Now, I want to ask you two things. One is obviously the growth outlook, where perhaps all the source of our revenues, our progress lie. What is the growth outlook? And we've seen that for this year, the growth outlook hasn't been affected perhaps as much from what the estimates were, but some people have started rolling back the growth outlook for the next financial year. So one is, what is the growth outlook? But more importantly, I'm going to ask and bunch these two questions together for you to have a shot at it, is that when we look back 10 years ago, a lot of people say that our growth story, which started, in the early 2000s and sped up right through 2000s, sort of lost momentum around 2011, 2012, and from there onwards, it was all about a story about NPAs and companies struggling and investment not happening. And then we've gone through this decade, which has ended with a lot of pain in pandemic. But even before the pandemic, our growth sort of decelerating quite steadily. Now, as we enter this next decade, and just sort of 2011, 22, when you look forward, not just 1 or 2 years, that is one question, but more from a decadal point of view, how do you sort of see that? Because not carrying as much growth momentum, we're not carrying as much prosperity as it were, which may not always be getting captured in the numbers. So how does that mean? And we look at a lot of, say, the population data, which said that India is going to overtake China and all of that. It's basically saying that, we are going to have this phase where a lot of young people are coming in, employment still remains a sticky point. What does that all mean going forward?
Sure, Udit. So first on the near-term growth, I think it's a tussle between current data versus narratives. The current data is still quite okay, I would say. Yes, it's maybe tapering off a bit, but nothing like falling off the cliff despite this high inflation, massive global uncertainty, etc. But any one of us can create a very negative narrative for the latter part of the year, whether it is about interest rates going up, whether it is about exports coming down because of global recession, whether it is persistence of inflation. There could be 5 reasons for it. And I'm not saying that those reasons are wrong, but that's still a forecast. And a lot of things can change in today's world. So my sense is that we'll have to very closely track the data momentum now, that whether this data momentum is falling off or not. If the data momentum does not fall off, then we can actually be surprised by this year's growth surpassing the current market estimates of people. We anyway have a slightly non-consensus higher growth forecast, and we want to hold on to this growth forecast for the time possible. Now comes the quality of growth issue. The quality of growth is not that good because it's still uneven. And we often refer to this as the K-shaped recovery, where the rich is becoming richer and the poor is becoming poorer. In every field, it's about larger companies becoming larger and smaller companies becoming smaller. So everywhere that issue is there. I'm not going to thumb the table here, but there could be very early signs of this reversing of it. So let's hope that the quality of growth during the course of the year also improves. But it's too early days to really make a strong comment on that. On your second question about the decadal growth, and this is obviously a much more blue sky exercise, but the way to think about it is that what is going to drive India's growth over the next decade? And in my view, without a recovery in the private corporate capex or the capex cycle, it's almost impossible to have a strong 6-7% GDP growth over a decade. And why do I say so? So let's go back to the period that we were mentioning, that 2011-12 period. And we were mentioning that we had a strong growth at that time, a momentum. I would want to turn it on its head and say that what you were calling as momentum was actually a headwind for us. A headwind because we created excess capacity at that time, which led to higher leverage for corporates, which they could not bear, which led to the bank's NPA problem over the next 3-4 years, which kind of killed growth or kind of killed capex growth for the next decade. So in some sense, now things have cleaned up. If you look at banking system NPA, they've come down very sharply. If you look at corporate leverage is down to almost a decade low now. So the system has got cleaned up. So it's a great time for the next CapEx cycle to start. But we all know that CapEx is about animal spirits. So something has to trigger that animal spirits for that CapEx cycle to turn up. Why this is important is that while in the last decade, CapEx cycle was missing, our growth was entirely driven by the consumer. And these consumers were not consuming out of higher jobs or income, but consuming in a leveraged way. They had reduced their savings significantly and they had increased their borrowing. Today, household debt, while corporate debt has come down, household debt is almost 40% of GDP, which is good 10 percentage point higher than where it was. So I think there is some kind of natural limit that is going to get set on how much consumers can spend in this leveraged fashion without jobs and income. You were referring to this demographics also, that 10 million people is going to join working age population from India every year over the next decade. So you have to create that jobs and income for these guys for the consumption story to persist. And to do that, we have to get into this CapEx cycle. And the tougher part is that in all likelihood, in today's world, that CapEx cycle will be less employment intensive. So in some sense, the problem increases because of that, which is why thinking about a 8% GDP growth for India sustaining for the next decade is difficult. I think 6 to 7% is a more realistic GDP growth, given where we stand today. What can change is if global environment becomes very conducive. In that 2004 to 11 period, the global environment was so conducive that our exports growth contributed significantly towards GDP growth. If things change over the decade and it becomes a tailwind rather than a headwind, then maybe we surpass these numbers. But otherwise, on a more sustainable basis, getting 6 to 7% GDP growth, I think will be a good achievement driven by a CapEx recovery.
Thanks. Thanks, Samiran, for such a detailed discussion. And I hope our viewers would have understood not just in a simple answers about what would be the growth or not, but understand the cogs, the way things function, the way the economy functions, and sort of let that inform their views, political or otherwise. So thanks again, Samiran, for sharing your time. And keep watching The Express Economist. We'll be back next week. Thank you.